Private equity is a theoretically sound concept where funds accumulate investments, purchase companies that are struggling or emerging, modify their structure, operations, and leadership, increase their worth, and then sell them off for a profit. However, let's examine the case of Yahoo. Once a trailblazer of the early internet era, Yahoo was more valuable than Amazon and Apple combined, with its market cap peaking over $125 billion. Things took a downturn when a proposed $44.6 billion acquisition offer by Microsoft was turned down in 2008, leading to a slow decline and eventual selling to Verizon for a mere $4.8 billion. The combined unit of Yahoo and AOL, also acquired by Verizon for $4.4 billion, was sold off to Apollo Global Management, a major private equity firm, for a mere $5 billion after continuous downward trends. Despite their previous investments such as ADT, Chuck E. Cheese's Qdoba, and AMC Theaters, they saw potential in Yahoo for value creation. To revitalize Yahoo, they appointed a seasoned business professional, Jim Lanzone. Lanzone had already proven his mettle with impressive turns at Ask.com, CBS's digital business, and Tinder. The new strategy under the direction of CEO Lanzone and investor Apollo involved shedding superfluous yet valuable assets to concentrate on Yahoo's core business, not just a miscellaneous assortment of revenue-generating resources. Consequently, key assets of the profitable, independently run Yahoo Japan were sold to SoftBank for $1.6 billion, whereas Edgecast, a streaming technology company included in the Yahoo/AOL merger, was disposed of for $300 million. Apollo Global Management was able to recoup its purchasing cost for Yahoo with just 2 sales, Yahoo Japan and Edgecast, which brought in $2 billion. Recognizing Yahoo as it was now allowed Apollo to see what aspects worked well, Yahoo Finance and Yahoo Sports. Experienced hires were made to capitalize on these successes. Ryan Spoon, from ESPN and BetMGM, was made president of Yahoo Sports due to his understanding of their fantasy sports audience. Tapan Bhatt, previously chief product officer at NerdWallet, was chosen as general manager of Yahoo Finance, bringing with him insights into the needs of a new generation of investors. Granting key sections within Yahoo a high level of autonomy allowed them to offer products tailored to their specific demographics. Yahoo Sports bolstered its sports betting capabilities, even acquiring sector startup Wagger in 2023. Yahoo Finance concentrated on expanding its subscription-based services, with its Yahoo Finance Plus platform, equipped with advanced trading tools and data, reportedly boasting over 2 million customers and showing double-digit year-on-year growth. Under new leadership, Yahoo underwent a transformation. They reduced their scope, strengthened their core, and it paid off. Despite being privately owned and not needing to disclose as much, indications are that Yahoo is healthier than it has been for decades and is reportedly on track to go public, very profitable, as stated by the CEO. This could be seen as a triumphant return on investment for Apollo Global Management, as they took a risk with a failing company, found competent leadership, devised a feasible strategy, and guided the company's transformation, restoring its relevancy. And this is exactly what the private equity industry would like you to believe private equity is. Structurally, private equity firms are not complicated. Their cores are the general partner. General partners typically know the right people. It is not an entry-level job. Private equity firms' core revolves around general partners. Some renowned examples include Mitt Romney of Bain Capital and Steven Schwartzman of Blackstone. Their valuable connections aid in fundraising. Initially, they invest a substantial amount of their own money, then persuade other investors to entrust them with theirs, often due to their expertise in specific industries. For instance, Childs had a knack for investing in food and beverage companies. He's known for negotiating the Snapple buyout, which was later sold for a significantly higher price. His argument is companies of this sector are a dependable investment as humans' need for food and drink is constant, making it less vulnerable to market fluctuations. This steady nature appeals to large institutional investors like insurance companies and employee pension funds. Although individuals can invest too, they must have enormous wealth because many funds require minimum investments of around $25 million. Private equity firms consistently profit by taking 2% of all money annually as a fee, regardless of investment growth. They set a growth benchmark hurdle, and if the investment surpasses this mark, the firm charges a 20% fee on the excess gain. For example, If a $100 million fund grows to $110 million, that $3 million profit would lead to $600,000 going back to the firm. The resultant earnings from the 2% base fee, which usually covers operational costs, is relatively consistent given the restrictions on when investors can remove money from the fund. However, the 20% fee can vary significantly. At times it might be negligible, and at others, it could be yacht money, which mostly goes to the general partner. This structure has allowed general partners like Childs to amass considerable wealth. Interestingly, the earnings from these fees are viewed by the US IRS as capital gains, not traditional income. Despite these gains not truly deriving from the general partner's investments, they're taxed at about 20%, significantly lower than the 37% typically levied on traditional income. The substantial wealth garnered by a general partner, GP, primarily comes from maximizing their firm's gains, typically via leveraged buyouts. GPs use borrowed money, rather than their own, to increase potential earnings. For instance, a $100 million fund can purchase a $400 million company with the help of loans, thus quadrupling the possible profit if value is increased. This strategy comes with risks, but can be highly advantageous for GPs due to the amplifying effect. As an example, a $400 million company bought using 75% borrowed money under a $100 million fund can lead to substantial income for the GP. A 0.25% increase in growth can yield an additional $200,000 income for the GP. How this value is created doesn't quite matter. Various companies, whether globally recognized or regionally confined, all play a part in this strategy. One such example is Marsh Supermarkets, an Indiana-based grocery chain that once had a significant presence in the state and nearby areas. Marsh Supermarkets started as a small grocery store, then expanded and diversified over the years, introducing convenience stores, bargain outlets, and upscale grocers under its brand. Marsh's strong regional presence drew the attention of Sun Capital, a private equity firm. However, despite its strong beginnings, Marsh Supermarkets couldn't maintain its growth. Struggling with rent and vendor payments, the company declared bankruptcy in 2017, closing all stores and liquidating assets. What was once a vibrant regional retail empire collapsed within 2 decades, aligning with the timeline of Sun Capital's ownership. The rise and fall of Marsh Supermarkets highlights a typical pattern under private equity management. It demonstrates a private equity firm's potential to leverage borrowed funds for massive gains, the inherent risks associated with such strategy, and the quality of decisions made in the process. Sun Capital Partners' acquisition of the once successful Marsh Supermarkets was not the primary cause of the grocer's downfall. Before Sun's purchase, Marsh had already experienced failed expansion attempts and increased competition from rival stores. However, Marsh's considerable real estate portfolio drew Sun's attention, leading to their acquisition for $325 million, paid through $88 million cash and an assumption of $237 million in outstanding debt. Sun Capital aimed to either revamp and sell the bumbling business or sell off the assets, including their estimably valuable real estate. Changes happened rapidly. Management was trimmed, the company jet was sold, and stores got a facelift which elevated sales. However, Sun Capital started selling store locations while still operating them as Marsh stores. The move, known as sale-leaseback, is common in private equity. It appears beneficial on paper as it can provide inflow for the private equity firm and short-term investment flexibility for the company. Yet the potential downsides, such as long-term, increasing leases on properties, can outweigh the benefits. Sun Capital began their attempt to sell the leaner Marsh chain as early as 2009, but the restructured company failed to attract buyers. Ultimately, Marsh Supermarkets went out of business in 2017, with Sun Capital managing until the day of its bankruptcy. Despite the declared loss of $500,000 on their investment, Sun Capital profited thanks to the governance structure of private equity. They collected annual management fees and commissions from sold assets during their tenure. However, the influence of private equity's investment model on Marsh Supermarkets' trajectory was significant. While the private equity firm turned a small loss into a gain, Marsh employees and consumers didn't share this fortunate outcome. The sale-leaseback strategy, alongside cost-cutting measures such as reducing staff and subcontracting services, played a role in the company's ultimate downfall. These maneuvers led to significant real-world consequences, highlighting the potential pitfalls of private equity engagement. Marsh supermarkets, embedded in urban Indiana and Ohio, provided healthy food options in areas on the precipice of becoming food deserts. Its closure left locals confused and upset over the disappearance of a long-standing institution. The employees too faced harsh consequences. Under Sun Capital, only the executive retirement plan was fully funded while the employee pension plan was underfunded by approximately $32 million. The responsibility to balance this fell on the government insurer, not Sun Capital. Additionally, Marsh owed $55 million to the warehouse workers' pension at the time of bankruptcy. The experience of Marsh supermarkets under Sun Capital mirrors a broader trend in American life, highlighting the often unclear effects private equity can have on industries as diverse as regional grocers, casual dining chains, unique sectors like animal retail and veterinary care, and the consequential healthcare sector. Formidable outcomes, such as job losses, declining care quality, inflated prices, and business shutdowns, are rampant. These are amassed under private equity's relentless drive for efficiency and cost-cutting. A study highlights that jobs at public companies acquired by private equity firms decrease by 12% within 2 years, translating to thousands of layoffs. Private equity-owned nursing homes witness an 11% higher mortality rate. Larger-scale private equity acquisitions experience a bankruptcy likelihood 10 times higher in the following decade. Theories to explain these adverse results revolve around the inherent issue of reducing complex organizations to figures on a spreadsheet. By disregarding the complexity of human factors, creativity, capabilities, and the like, private equity firms often fail to strengthen company culture in ways that might promote innovation, collaboration, and competition. Stories of private equity positively transforming the human aspect of companies to create more robust, competitive products are relatively scarce. Private equity often employs aggressive strategies such as price hikes, lobbying for legislative benefits, mass layoffs, heavy corporate debt, and asset shuffling to bolster their returns. This systemic exploitation is generally easier for top-level decision-makers who are detached from the ground-level impacts of their choices. The complex structure of private equity also facilitates this, placing numerous layers of management between the decision-makers and those affected. General partners at the top have incentives to exploit smaller avenues for profit. The industry's compensation model demands extreme growth, which often incites ruthless tactics. Such strategies might include cheap but less efficient outsourcing, small modifications that significantly affect a partner's annual income. These actions, shielded by bureaucracy, receive a beneficial tax treatment in the U.S., further augmenting the gains for the general partners of American private equity firms. It's a beneficial system, particularly if you're at the top.